Bloom Energy lost money every single year for 24 years. Last quarter, it did $1 billion of revenue and kept 33 cents on the dollar. So here's my call. 60% odds Bloom is still earning a gross margin above 30% 4 quarters from now, on revenue at least 50% higher than today's. That's the whole argument compressed into one line, whether that margin is a price or an accident of scale. Because it took 24 years to put 1.8 gigawatts in the ground, and then Oracle signed a master agreement for up to 2.8, which is larger than everything Bloom had ever built. And the stock is down 43% from its high anyway. Here's where I split from both sides of this. The operations are not the bubble. That margin is audited and it is real. What's stretched is the entry price, because at roughly 280 times trailing earnings, you're not paying for this year at all. You're paying today for 2029. Bloom doesn't sell electricity. It sells the box that makes it, sitting on your own property, running on natural gas without combustion. That distinction turns out to be the entire business. A large data center that asks a utility for a grid connection waits somewhere between 2 and 5 years for it. Bloom shows up in about 90 days and scales from 20 megawatts to 500 on a single site. So the product isn't really power. It's time, and time is the one input in AI infrastructure that money currently can't buy. Oracle wanted on-site power at one AI campus, gave Bloom a 90-day target, and got the first system in 55 days, 35 days early. That single number is why the relationship went from one campus to a master agreement covering up to 2.8 gigawatts across Oracle's operations. And it didn't stop with Oracle. American Electric Power, a utility that could in principle build its own generation, signed for up to 1 gigawatt instead. Equinix took 100 megawatts. Then on June 30th, Brookfield expanded its partnership with Bloom from $5 billion to $25. Now, run the arithmetic nobody in the coverage runs. Oracle's ceiling plus American Electric Power's comes to 3.8 gigawatts. Fremont, after the expansion Bloom says finishes this year, makes 2 gigawatts a year. So 2 customers alone are close to 2 years of the entire factory before anybody signs anything new. Management talks about 25 gigawatts of pipeline visibility, which at 2 gigawatts a year is more than a decade of production. The binding constraint here stopped being demand a while ago. For most of its life, Bloom's problem was never demand. It was that every box it shipped lost money on the way out the door. Look at what just happened instead. Second quarter revenue came in at $1.065 billion, up 165% year over year, with product revenue alone up 215%. Gross margin reached 33.4%, an improvement of 668 basis points in 12 months. The balance sheet moved with it. $2.7 billion in cash and $226 million of operating cash flow generated in the quarter. Compare that against what this company carried into its 2018 IPO, which was an accumulated deficit of $2.3 billion. The technology didn't change. The scale did. One number separates this sector cleanly, and it isn't revenue. In the same quarter, Plug Power did $178 million in revenue at a gross margin of negative 0.9%. That is a genuine improvement because a year earlier the same line was negative 30.7%. But still means Plug doesn't yet make money on the sale itself. Bloom did 6 times the revenue at 33 points of positive margin. That gap isn't a difference in execution. It's the difference between a company that has a product and a company that still has a project. If you track AI power the way I do, subscribe, because the next teardown is the gas turbine order book. I'm not going to pretend the bears are holding nothing here. Enterprise value sits near 640 times EBITDA. On July 7th, a short seller published a report attacking Bloom's scandium supply chain, and delays were separately reported on the Oracle and AP projects. Then on July 24th, the entire group unwound together, with Bloom down 13%, Fuel Cell down 9%, and Plug down 4%, which tells you how much of this ownership is thematic rather than analytical. None of that has touched the income statement yet, and yet is doing real work in that sentence. But here's the risk I don't think the price reflects at all. Every headline number in this story is an up to. Oracle's agreement is up to 2.8 gigawatts. American Electric Power's is up to 1. A master agreement sets a ceiling, it doesn't commit a volume, and revenue only books when a system actually ships. So a customer that quietly slows its call-offs never has to announce anything. The ceiling doesn't move, The $20 billion backlog headline doesn't move, and the only place it surfaces is the delivery line. My threshold is this. If product revenue growth falls under 50% year over year, while that $20 billion is still being quoted, the ceiling is decoration. Bottom line, Bloom stopped being a fuel cell story and became a lead time story, and that shift is the only reason the margin finally turned. The single load-bearing reason is those 55 days. Oracle didn't expand to 2.8 gigawatts because the chemistry impressed anybody. They expanded because 55 days beat a 5-year interconnection queue and nobody else showed up with an alternative that worked. If I'm watching one name in on-site power, it's Bloom. And not because it's cheap, since it plainly isn't. It's because Bloom is the only one in this group shipping at a positive gross margin at gigawatt scale. Plug is the cheaper entry and the harder case because it still has to prove the margin first. That's a lens, not advice. The call once more. 60% odds Bloom still earns a gross margin above 30% when it reports the June 2027 quarter on revenue at least 50% higher than today's. 3 things I'd watch, each with the level that tells you I'm wrong. Gross margin, currently 33.4%. If it slides under 30 while revenue is still climbing, the pricing power was temporary and the call fails on its own terms. Product revenue growth, which just printed 215%. Under 50% is where those up-to contracts start looking like ceilings nobody is drawing down. And Fremont, where the expansion from 1 gigawatt a year to 2 is supposed to finish by the end of 2026. A slip past the middle of 2027 would mean the binding constraint moved from the customer to Bloom's own factory floor. And what would change my mind outright is simpler than any of those. A quiet reduction in a contracted gigawatt figure at Oracle or AEP. Backlog that shrinks without an announcement is the real tell, because that backlog is the number this entire multiple rests on. 24 years of losses, and then a single contract larger than everything that came before it. The technology was never really the open question here. The clock was. I'm Big Z. Follow me. See you in the next deep dive.